Now it's the time for another insightful panel discussion on the topic, what is good approach for funding and scaling a sustainable startup? Our first panelist is Mr. K. Ganesh. He is a successful serial entrepreneur with 4 successful greenfield ventures and exits. His last venture, TutorVista, was acquired by US and UK listed education leader Pearson for $213 million. Over the last few years, he has promoted leading companies like BigBasket.com, Portia Medical, and Fresh Menu, among others. We have Mr. Ravi Bhushan as our second panelist. Mr. Bhushan is the founder of Bright Champs, one of the fastest growing EdTech startups. He is a technology leader with a passion to bridge the gap between academic education at schools and what skill sets are necessary for future technology leaders of tomorrow. We have Mr. Siddharth Pai as our third panelist. He is a founding partner at 314 Capital. As part of the 314 ecosystem, he has helped close over 120 plus funding rounds and investments into 35 plus different funds across private equity and public markets. Moderator for this panel discussion is Mr. Anand Sudarshan. Mr. Sudarshan is founder and director of Sylvant Advisors Private Limited, which provides strategic advisory services in the education sector to Indian and global institutions, large enterprises, and investors. Additionally, Sylvant incubates, invests in, and advises startups and early age companies. May I request the audience to type in their questions in the chat box? They will be answered at the end of this session. Over to you, Mr. Sudarshan, for further deliberations.
Thank you, Dr. Neha. Good evening to the audience. Good evening to my fellow panelists. It's a privilege and honor to be amidst all of you and have a chance to interact with you and share thoughts on the topic, what's a good approach for funding and scaling a sustainable startup. So the premise here is the startup has become sustainable. So it's all about the right approach for funding and the right approach for scaling. So let's use that as the foundation in having the conversation. And as I requested, we keep the conversation tight and sharp. We'll it's 4:42 now. We'll have the next 20 minutes for a conversation between all of us, and then hopefully they've sent me a few questions, and then hopefully there will be more questions from the audience. I will intersperse the questions that have come up in the conversation with you, and then we'll take it on from there. Is that okay? Right. So Ganesh, let me start with you. You are an absolutely seasoned and successful entrepreneur. You have seen multiple stages, and you have been through not just the ups and downs, but also the transformations, orthogonal transformations of companies that you have started and run and grown. First question for you is, post-pandemic, the basic fundraising, the fundraising basics that existed post-pandemic, have those fundraising basics changed? And if so, how have they changed, and what are they? Quickly, if you can give a summary for the audience, that would be nice.
Yeah, so there has been pleasure to be here. Of course, NIIT, RSP, VKT, and others, we have a very, very long association and very fond memories. So always a pleasure to be in the NIIT family, speaking in this event. So I think there's a lot has been talked about the funding winter, the huge euphoria that happened during the pandemic, and the way some of these sectors, especially those which got tailwinds because the pandemic, moved up, and also the sudden gloom and doom and post pandemic return of normalcy that's happening now, the challenge that we see, and the layoffs and the funding freeze and the down rounds, all of that is getting talked about very, very soon. So firstly, I don't think we should attach too much of importance to this kind of cycles of funding, huge euphoria followed by gloom and doom. We have seen this number of times, Anand, and you have been an entrepreneur for decades now, even before entrepreneurship became popular. You've also seen it across multiple cycles. So firstly, this is part and parcel of the cycle. For those of you who are first time entering or have just entered or have not seen multiple cycles, just chill. We have seen this over multiple, whether it's dot-com boom, dot-com bust, Lehman Brothers, September 11, all of that's happening. That's how people like Anand and me have lost all our hair, even though many of the other people have, like Sid, Siddharth have got great hair because they have not gone through it. They will also come there. So firstly, this nothing is new. Okay, right? Secondly, what has happened? What has happened is, obviously, in the pandemic, all of us, whether it's entrepreneurs, whether it is investors, whether it is the general ecosystem, obviously tend to get carried away. It's a once-in-a-century pandemic. We thought the consumer behavior has changed substantially for good, while all of us did understand and realize that there will be some pullback or return to normalcy. While we appreciated that, we never understood or we never realized the extent of the pullback that happens. It's not just with education, whether it's education, whether it is telemedicine, whether it is healthcare, or even other companies in retail space like Big Basket. All of them saw a huge tailwind. We expected the tailwind not to last, but post that, what we have seen is with a revenge as people gone back to normalcy. So that has upset the estimate of everybody. So whether it is building up more capacity, in case of education, more teachers and more capacity to service, or in case of product companies trying to get on to a lot more cool, nice features meant for the pandemic, which we built, the investments that went in, all that seems to be over invested based on more than possible optimism that was needed. So now the correction is a challenge. It's almost like saying it, people will need more sanitizers, people will need more masks, therefore let's build huge capacity for sanitizer and mask. Now, obviously, people knew that this level of mask, a number of masks and the quantity required will not be as much, but they do not expect how much will it fall to. So that is one standard problem that has happened. In addition to the usual cycle, the venture capitalist or investor infused euphoria for growth, for market share, then suddenly followed by path to profitability, unit economics, and this, which is a cycle that keeps happening. I think all of that has combined together. But there is nothing to worry. People are sitting on a lot of money. The money cannot be put in fixed deposit. It will come into venture capital investments. VCs who have raised money for VC investment. They cannot put it in public stock market. They can't put it in fixed deposit. So all of that is very, very, very good news. But very clearly, for people who are in the Trishanku or in between, that means who are expecting to the euphoria to last and they're planning a fundraise in the last 6 months or next 6 months, there is a big challenge if they run out of money, because right now it is a freeze. Nobody wants to catch a falling knife. People are waiting for dust to settle. So if you are a company that you are caught in that Trishanku of 6 to 12 months of runway only available and you have to raise money and money is not coming in, you need to do everything, including rationalizing costs, postponing fixed investments, doing all that to survive for the 6-12 month period for this to come. But again, good news is being done, been seen that before. So that's a short answer to the funding situation.
It's Ganesh. So just chill. I mean, I honestly think that's the best way anybody could summarize that. You know, just don't get worried about all this. These are stuff that has happened. Perhaps not with this level of intensity that the EdTech sector that we saw, but this is not uncommon. We have seen it before. You are absolutely right.
Anand, one point here, what has also made it very stark is not just that's not for first-time entrepreneurs, even for us, is the last 12 to 24 months before this thing started, the run-up, the number of startups, the unicorn valuation, the ticket sizes, the fundings, they're all at stratospheric highs, even for people like us. Therefore, when it has gone to such level, it has never seen. The normalcy seems to be a steep fall because you have gone into stratospheric heights, which did not happen in the previous cycles I mentioned. There, it did not go to the valuations and ticket sizes and the quickness with which the fundings closed over video calls. We have never seen this. But because that happened, the fall seems to be that much more drastic.
Newtonian physics finally has to have its play. So gravity worked and everything had to come down, and it did. And you're right. The the exuberance that was there was beyond anything anybody had seen, and therefore everything had to come down. On the same note, Ravi, you have seen the business go through the pandemic and coming out. I think Ganesh's words, I'm sure you will echo them. They contain a lot of weight behind them. And one phrase that he used, which was very clearly, keep your cash or funding runway or cash runway in your company for the next 6 to 12 months, if you are in a position where you have to go raise money. Now, as an entrepreneur who's growing a very successful, very fast-paced company, how do you respond to what Ganesh is saying? And how does that juxtapose to your larger strategy that you must be having in place as you come out of this? And we were just chatting in the green room before, and we were talking about how only less than 15% of your business comes from India, and rest comes from outside India. So where do you put the whole thing together? What does it look like for you?
Sure. Thanks, Anand. Thanks for having me. And I'm very proud and glad to be here as part of the panel discussion. I echo with everything. I second every thought which Ganesh shared just now. At the end of the day, what we all need to understand is that without the right business fundamental, whether it's a funding winter or summer, doesn't matter. You have to ultimately build a good business, right? And which is self-sustainable, right? Without that, you can increase your longevity for some time if somebody gives you more fund or the other way, but ultimately you have to solve the real problems and make a credible business, right? So that goes without saying. In our journey, as I said, of course, we started the company at the peak of the pandemic, but we were also aware of the fact that there is a lot of nitro boosting which has happened in the sector because of the pandemic situation, and things will come back to normal. If we fool ourselves saying that no, this is the new world and pandemic will never get solved and things will always be like this, then you may end up wasting more resources and you may end up inviting more trouble for yourself, right? So we were knowing, nobody could predict the time, but we were knowing that things will come back to normal. People will start going to schools. Education will come back to a lot of pre-pandemic stage. But then you have to believe in what you are doing. So what I will say is that there are a lot of business model, a lot of educational startup came into picture during pandemic, which were an after effect of the retrofitment of pandemic situation into people's life, right? Which is, for example, people started teaching dance and sports online, right? I think that was one extreme of it, right? These are very physical activity, does not require online. Sounded like the very first moment somebody says about it, it sounds like a retrofitment, right? So what I mean to say is that, but at the same time, it was very evident that the behavior and the convenience factor of the online piece will be there. Of course, pandemic nitro boosted a lot of those things. And when the pandemic will be over, a lot of things will, reverse back. But that doesn't mean that, the things which are more suitable for the online nature delivery, they will evaporate out, right? So they will remain. Maybe the growth, the steepness of the growth will not be exactly the same as it was witnessed during the pandemic, time. So what I mean to say is that if you are looking forward to a larger than life outcome, if you are sorted that the world will set itself towards this direction, whether you get an additional catalytic effect during the pandemic or not, that's a temporary sort of thing. But if you think that what you are doing is the direction in which things will move forward as far as the education piece is concerned, so pre-pandemic, post-pandemic should not change a lot of things in your company, right? You have to figure out that ultimately the key matrices which are very important to run a sustainable business in education, which is for example, what is the lifetime value of the customer, right? What is the learning outcome of your user? What is the acquisition cost? All those things need to be solved at a very fundamental level. And if you are in control of those important matrices, I think one should not worry too much about whether this is pandemic or not pandemic, right? Of course, if macro is favoring you then you need to accelerate your business growth aspirations accordingly. And if it is not favoring you, you need to recalculate and recalibrate your growth aspiration. But that doesn't mean that, things have come back to normal and things which are supposed to go online will completely go away, right? What I feel that, businesses who are focusing on the fundamentals will remain the darling of the VC industry, right? Of course, there were a lot of more than required euphoria during the pandemic time in the EdTech sector and some of the other sector, because there were a lot of nitro boosting which had happened. But that doesn't mean that the sector is going anywhere, right? The businesses who are sound in terms of business fundamentals, business matrices, they will get rewarded down the line also. As you said that, VC funds are going to be deployed in the startups only, right? They are not going to be deployed in fixed deposit or, public market, right? So that way, I think, the important thing is that focus on those fundamentals, stay connected with what you started the company with. And if long term you believe that, the world will change in this direction, then keep on building and, make sure that, you are not burning or splurging the money or squandering the money more than a certain threshold.
Right. So I heard three things from you. Number one is critical, essential, desirable. If you were to build segregate the businesses into three parts, so long as your business is either critical or essential, then the desirable may go up and down depending on the up and down of the marketplace. The business will be there, and education, for example, is certainly in that category. And second thing, what you said is whatever it is, even if you are critical and essential, you said that you run the business properly, focus on the right matrices and run it properly. And the third thing that you said is calibrate. As the macros go up and down, calibrate and be very careful. And if you do these three things, and if you have the core conviction in your business, everything should be okay. Is that a fair summary, Ravi?
Absolutely. That's a very clear and fair summary, Anand.
All right. Sid, let me come to you. Let me come to the investor now. And I just going to tell Ganesh, the reason he and I don't have any hair and you have hair is because investors have all their hair. It's the entrepreneurs who lose all their hair.
No. Actually, Anand, I fundamentally disagree. The entire purpose, if you actually have to summarize investing in a nutshell, investing is a lot like the old Eagle song, Hotel California. It's very easy to get in. It's impossible to get out.
To get out.
So you should actually make it converse. It's always the entrepreneur loses his hair to actually get the investor in. The moment the investor it's the investor who ends up actually losing his hair to a large extent.
As you can see.
They not lose their hair, they end up losing their
Anand, not true. Never seen an investor. Not there, but that's a topic over drinks. Anand, we'll do that in Bangalore.
I know one of these days, cats sit over a drink and then we have a nice conversation.
Let's not get VKT and RSP into that.
But let me ask you this.
Why would you exclude us?
I totally welcome both of you. Let me ask you this. You heard one critical thing that Ganesh said, and in a different way, Ravi echoed, struck me, which is, there is an exuberance in valuation that happens at a point in time, which we've seen happen over the last 2 years. So I'm going to put you a bit on the spot, and pardon me for that, but also ask you, what is your advice to, therefore, as an investor, to all these young entrepreneurs? Now, any investor, anybody, gray hair, no hair, investors will turn around and tell entrepreneurs, build a company that delivers value. Now, the thing that drives investments is not value, is valuation. And there is no ambiguity about it. Valuation drives. And like Ganesh very correctly pointed out, irrational exuberance. There is a price. It has to fall down. It goes up, it has to come down. And it comes down, well, investors do get a hit. The one that really gets a hit is the entrepreneur. And in that journey of irrational exuberance, what is the role that the investor plays? What is the role that the entrepreneur plays? What is the entrepreneur what should she or he look out for in this rush that happens? So, and at the same time, by the same token, when there is a down that we have seen post-pandemic and this is the investment winter and all this nonsense that everybody keeps talking about, how should the person avoid despondency? This yo-yo business is not good. Neither the irrational exuberance nor the dark despondency is really required. As an investor, what is it that you look at when you look at entrepreneurs and business models and companies? And if you can answer that, keeping in mind what I just explained before that.
Chana, that's actually a fantastic question. So see, everyone knows about the efficient market theory, but not many people know about the irrational market participants that actually inhabit that entire market theory. So economics is the only science where you've actually managed to have irrational players, but you suddenly have an efficient system built on irrationality. So there is a contradiction in terms that's actually inherent in the entire system itself. And we've seen this contradiction actually play out more often than not. There are essentially only two emotions that actually underpin the entire investing journey, either from an investor side or an entrepreneur side. There's fear, and then there's greed. And depending on market conditions, it's either fear triumphs greed, or greed actually ends up triumphing fear. So we actually look at it. And if you actually speak to any of the entrepreneurs, anyone you know, Anand, there's not a single entrepreneur who's ever gone to an investor and said, no, don't give me this higher valuation. Please cut my valuation down by so much. That's never happened. I don't think that'll ever actually end up happening. So the reason why we have these sort of exuberant cycles is the greed portion of it actually overcomes rationality for both the investor side and the entrepreneur side, where there's a massive bidding war. Because the moment there's a paucity of good assets in the market, as we've actually seen during the pandemic itself, they want as many digital companies as the total amount of liquidity that was actually injected into the financial system and actually made itself available from the point of view of venture capital and private equity itself. That's why we've seen massive bidding wars, and we've seen most of the assets that would actually come out, let's say a 6x in terms of a multiple, will suddenly come out in close to 20x as part of that. And when the entire sequence is actually changed, when liquidity is being pulled out of the system, we've seen even good companies that could command a 6x and now actually commanding a 2.5 to 3x. We're actually seeing that entire part play out. So there's a reversion to the mean that actually ends up happening. The most important part over here for any entrepreneur or investor in that particular matter is to always decipher the signal from the noise. The business fundamentals, what Ganesh has spoken about, what Ravi's also spoken about, will actually always hold good. The moment you have a strong business, it can actually end up generating cash, which is the end purpose of any business after all. The ability for you to command any sort of valuation in the market is actually, all the power actually rests with you, not with anyone else. And with regard to chasing, with every investor actually speaks of value as part of that, but valuation has now become a proxy for value. Both of them need to actually go. It's value that actually drives valuation. Valuation never driven value. If valuation actually drove value, we wouldn't have down rounds right now. We wouldn't have companies or investors saying that these companies are actually overvalued. It never really happens that way. So see, the thing is, the vagaries of the market actually end up playing a very, very strong role when it comes to running a business itself. And these are conditions that are completely out of your control. No matter how good your business is actually doing, if there's a recession, there is a world war, no matter what, markets are actually going to end up collapsing. These things happened during COVID as well. Companies that had a fantastic 2019 year, in 2020, no matter what happened, all their stock prices actually collapsed until the Fed and central banks actually stepped in to actually keep that up. And I think given the fact that inflation is at such a high rate right now, we do expect these kind of market conditions to actually continue. So for anyone who's actually looking to build a business, remember the fundamentals, because those fundamentals are going to be the only thing that allow you as a business to actually continue and to actually sustain. If you've seen it, the market, and especially the media, not just in this country, but in every country, does an outsized role in terms of amplifying the highs and the lows that happen as well. So early 2020 was all about doom and gloom, the world's going to end. The end of 2020 and early 2021 was, this is the best time in the world. There's ample liquidity all around, stimulus checks floating out about. You've had rubbish like some Dogecoin or these sort of weird crypto coins also commanding sky-high valuations. Now we've seen rationality and sobriety actually come back to the market itself. And right about now, we're actually going through the hangover phase. As anyone who's actually gone to college will also know, there's always a very strong hangover phase that actually comes about. So we've seen what most people end up going in a 20-year cycle. The entire generation of entrepreneurs now have actually gone through in the span of a couple of years itself. So it's a massive acceleration of a very large cycle that's happened. But the companies that can actually come out of this strong, for example, Apple as a company is still actually doing extremely well because Apple's actually stuck to its business fundamentals. It hasn't exactly wavered when it actually comes to a particular commitment. Similarly, as an entrepreneur, even the startups and some of the startups in this country, especially the B2B startups, they've actually put their head down, they've actually executed, they've actually built. When times are good, they raise a large amount of money. When times are bad, they have a very large war chest that they can end up actually weaponizing in terms of acquisition or anything like that. So the important thing over here is don't actually let valuation become the benchmark for the value of your company. In the long term, the markets are highly efficient. The markets will actually reward good companies as part of that. So even now, we've actually seen far too many entrepreneurs say, you know what, my previous valuation multiple was let's say 15x. Why should I settle for a 8x as of now? That's almost a 50% haircut. But if the entire market's actually commanding 4 and you're actually getting 8, by all means take it. Even if your valuation is low as of now, the fact that you survived, you could actually build your business, means that the market will actually reward you in the long run. This myopic view that entrepreneurs often have, and investors also often have, and investors have it far more often than entrepreneurs as part of that, that actually ends up fundamentally undermining the entire process itself. So far too often, we actually end up getting caught in these small-term vicissitudes rather than the longer-term signals that actually ends up getting generated. And unless entrepreneurs can actually take a step back and bring in some amount of rationality into that, we will actually see these kind of cycles happen. If times are good, by all means, command a high valuation, actually run for it. If times are bad, survivability will always actually overtrumps your ego. You can't let your ego come and say, I wanted such a high valuation, I can't settle for something lower. The fact that you got the money, the fact that you survived, you always live to die another day. And that day should actually be far further down the line than what it is as of now. So that, I think, is actually the core message that anyone can actually take away. Both sides are irrational, both sides are greedy, both sides are fearful, both sides are human, both sides go through the same emotion. You don't expect the other side to actually end up having any greater amount of sympathy for you than you would ever offer them. So it's a give and take as part of that. So the moment you understand these kind of equations, I think that kind of mental model will hold you in very, very good stead as you go through the entire journey of being an entrepreneur.
Right. So lots of takeaways from that, Sid. You're saying, focus on the fundamentals, as has been said by Ganesh and Ravi. Ignore the noise, avoid it, and don't get distracted. And you said that value precedes valuation. Value is real. Valuation is beauty on the eyes of the beholder, and it can change based on the context. So don't get distracted. And you're saying that
just to interject that anybody can actually become a unicorn. It's the simplest thing to actually do. Just issue, let's say, $1,000 worth of share for 0.0001% of your company. Automatically, the value of a company is like $1 billion or like 100,000 crores or whatever grand amount it is. Valuation, after all, is just a vanity figure that's actually there. Now, the thing about valuation is other people need to actually pay that same price. And that's always going to be dictated by market conditions. So people always forget that. Even the largest valued startups you see now, like Lana, for example, they've lost close to 90% of their value. Now, you can debate whether the current value is the true value or whatever the 90% they lost, that was actually the true value. That's actually debatable. But valuation is a snapshot as of a particular point in time.
It's a balance sheet item. It's an asset and on that particular date. So absolutely, that makes a tremendous amount of sense. And like I read yesterday, somebody in Singapore said unicorns have to learn to become cockroaches to reflect on what Ganesh said. Just focus on cash flow, cut all the costs down, and then survive. And I think unicorn becoming a cockroach is I thought it's a very good metaphor. But let me
one more thing on that. You can't have a business model that can only be sustained on periodic injections of capital. One of the great failings of the Indian startup ecosystem, I'm sure Ganesh and I have actually spoken about this on a few other panels as well. The moment your business model is contingent on actually raising millions and millions of dollars every 6 months, 9 months, 12 months, etc., that's not actually a sustainable business. It's actually more or less a black hole, right? You can keep actually shoveling billions and millions of dollars, never actually see anything actually coming out. It basically becomes Hotel California once again. So you need to have a business from day one, where you can take advantage of market conditions. And if you have to cut out all the fat, cut out all the fluff from your business, and make sure you have a business model that can inherently generate cash. If it can't, no amount of external capital, no amount of M&A, none of that will actually protect you. You're just actually prolonging the inevitable. So these sort of dislocated business models that became the norm because we lived in an era of low interest rates. As the interest rates rise, we're going to see that entire set of business models actually crash and actually move away. And I think that cleanse that's actually undergoing now, and that will end up happening over the next 12 months, is actually very good to actually remind everyone about the true nature and the vicissitudes of the market itself.
So let me shift gears here, given the fact that we have only a few minutes left, and really talk about scaling as well. And I'm going to start with you, Ganesh. Very quickly, in a minute's time, you've scaled companies. You've really started absolutely with zero and then scaled companies up multiple times. What are the 2 or 3 takeaways that based on your experience, that you would like to leave as thoughts?
So, no, I think firstly, it's very important to realize what problem you're solving and not get carried away by the early adopters of a problem. See, we entrepreneurs are very optimistic, okay, right? We are very passionate. We get excited by the idea and start off. I loved it when Ravi mentioned about music or online yoga and all that stuff. When we did TutorVista, the first portion of TutorVista for US markets, I was very passionate about teaching Carnatic music to US kids. Okay, right? Fortunately, my partner Shri said, "Don't even go there. Don't even go there." Okay, right? Now I'm very convinced because of my own experience that people would love to have Bangalore-based Carnatic music teachers for their kids in the US because they miss India and all that stuff. But if we had done that, we would have got a small number of users, early adopters, very passionate, but it's not a scalable business in terms of the cost of acquisition or any of those, even at the best of the times. Okay, right? So coming back, is it scalable? Are you talking, what problem are you trying to solve? Okay, right? Education is very, very, very funny business. We had I'll take a minute. In TutorVista, we had a TutorVista business, which is for the US. We had a large India business where you know it. You're part of the Manipal group, and which was an investor in our business. We had a K-12 schools business, schools management business, EduRite business of selling technology to schools, and a tutorial business. So we had all of that in India business. It's a very tough, complex business because the nature of the problem for US market and Indian market is very different. And in fact, Byju's White Hat, one of the challenges they are facing is, I presume, is also that. What is the key difference? In US, it is a cost problem. It is not a quality problem. Okay, right? In US, you're talking about a country where the public school system is good, where education is the 7th largest discretionary spend of the family. 6 items are before that. In India, education is the 2nd largest spend of the family, right? It is a quality problem. People will sell half their net worth to educate their child. So provide good quality, you can do that. In US, you have to address it with cost. 1. 2, consumer internet business is extremely difficult to build given the cost of acquisition and this. If you're talking about US market, B2C cost will kill you. The cost of acquisition will kill you. If you look at Blackboard, if you look at University of Phoenix, if you look at any of the successful business models that have worked in US, either it is B2B or it is funded by loans from the government. It's not really B2C. University of Phoenix, for example, online, which you are very familiar with, given your past background, was through the loans from the government. It was not really a B2C business. The B2C business, to crack that, is very, very difficult. Okay, right? To sell to institutions is a completely different model. In India, if you start selling to institutions, selling to schools, it's a very different model. So are you solving a quality problem or are you solving a cost problem is very important to understand before you can really scale and not get carried away by the very early one. What has pandemic done is thrown one more googly into it. Okay, right? Before pandemic, we used to worry, is it a quality, is it a cost? Pandemic created an access problem. So because of pandemic, things were shut down. Access was an issue. Therefore, online yoga or online learning, online dance, and even to that extent, Big Basket equal online grocery, all of that came up very well because access just was not there for alternative. Now, the moment the access got opened up, people wanted to send their children to physical classes. They want to do physical yoga. They want to do the networking. They want to go to the park and do the yoga. With a revenge, they are doing it. So this access problem got exacerbated or got came into focus during pandemic and got quickly removed. So in short, scale after you have really cracked what is the problem you're solving. Is it beyond the early adopters? Is it beyond the first few people who are passionate about app, about learning new things? A lot of people will try out. But is it sustainable? Is it really large market? And last point, in US, for example, if you don't get educated, okay, you don't fare very, very badly. You have social security, you have some basic healthcare, you have basic sustenance, the safety net is there. Therefore, the priority for you to spend on quality of education is low. In India, you have seen how we run after test preps, how we run after it. In India, there is no such thing exist. If you do not get yourself educated, you're not going to get a job. If you do not do that, you're going to be in misery. You will not be able to take care of your children. You will not be able to take care of your parents. You will not be able to live a post-retirement. You have no other security nets. Therefore, the focus is very, very different. So understand that before you scale and see if you're solved for the right problem and not mixed up in these issues. I'll stop there in the interest of time.
So thanks, Ganesh. So you're saying very simple, understand which market you're serving and understand it really well. And as you scale, the market requirements will change. You understand that very well and have a complete understanding of the cost side of things as much on the other side of things. And that's where lies the basic truths, some of the truths to scaling. Ravi, let me just come to you now from a scaling perspective. You are at that point where many of these you have already applied and you're finding, scaling happening. Ganesh is one person whom I know who has understood or at least operated extensively to understand the dynamics of the US and the Indian education markets, as you can clearly see here from what he said. What has been your experience in the last, let's say, 12 months as the world has come out of the pandemic? The business that you are in, where it is choice-based because you're offering it as a choice, you are not tied into the regulatory side of stuff, your business. And when choice is involved, are you finding reflections of some of the stuff that Ganesh has, talked about? And very quickly, is there anything that you would like to add on top of it? 30 seconds.
Sure. No, scaling an EdTech business, I'll just add, a few points based on my experience of, scaling Bright Champs. I think most of the business model in EdTech, they are negative working capital sort of, model, wherein you just pay you upfront and then you deliver the services, right? So if you are scaling the business, try to grow the business basis the customer funding rather than VC funding, right? And the money comes upfront, unlike many other businesses. So if you are creating a situation wherein the definition of funding you change in your mind as customer funding or customer revenue rather than the VC funding, I think that's one important guardrail for yourself to figure out how much to grow. Second is, whatever you are doing, if you are not able to witness any flywheel effect of whatever you are doing, right? If there is no learning outcome and there is a word of mouth and there is a referral and there are so many ripple effect of if you are doing a good job, right? So there are some early indicator like NPS and all those things. But once you do a good job in whatever type of education you are delivering in the society, and after some time it will start strengthening your core fundamentals of the business. If you are not able to see it, in 6 months, don't try to push the pedal and try to nitro boost the growth, right? That will hit you hard, right? So I think be very sensitive about the flywheel effects which can happen if you are doing a good job as far as the delivery quality is concerned. And if you are not seeing enough signal around that flywheel effect, don't go for a scale. Rather fix the fundamentals and and work on those things for a longer time, right? And third thing I will say is that I have found founders in EdTech who are very obsessed about product. I found founders in EdTech who are very obsessed about solving distribution problem. It's a combination of both, right? You can't make a beautiful painting and keep that in a dark room and expect the appreciation of that painting to happen, right? You need to have a right product and people need to see it, and enough people at the scale need to taste that product. What I'm trying to say is that don't go overboard on either of the thing, right? Don't over invest on product building. Don't over invest on just acquisition piece, right? Acquire some customer, deliver in a good way, right? And try to see that, whatever effective acquisition you are doing and delivery you are doing, is there a positive side effect of, that effort, right? If there are ripple effect, which is generating additional strength in your business, I think, you are on the right path. Yeah.
Excellent. The two words that I absolutely love is to an entrepreneur is understand your context at all times and maintain a balance at all times. I think chances of success are significantly greater. Sid, I'm coming to you last, very, very quick one. Data that you get as an investor from your investee companies represents the past. It's financial data, some matrices, etc. All of them represent the past. Sure, I mean, the past does point a certain trend towards perhaps the future, but over and above that, what is it that you look for in an entrepreneur? Over and above the data that you get, what is it that you look for in an entrepreneur that gives you a good sense of confidence that scaling is likely to happen there?
So Anand, to borrow a line from one of those mutual fund ads, past performance is not an indicator of future performance at all. So I think that's very important to actually put it out over there. No, but the question you asked is great. See, the greatest risk in investing is actually not the product turning out to be around, not finding product market fit, not the ability to raise capital, change in regulations, turmoil, etc. It's actually people risk, especially in the early stage, and for a company to actually end up scaling. The entire bet is actually on the entrepreneur and the ability for him to pivot, for him to find product market fit, and for him to actually engineer that. If there is any failure over there, failure in terms of selecting that particular person, the entire enterprise actually ends up becoming doomed to fail. That's actually the most important thing. So the most amount of time needs to actually spend with the entrepreneur, and more often than not, actually gauging the entrepreneur's ability to actually handle bad times. If the times are good, if the times are good, capital actually forgives a large number of mistakes a person actually ends up making. But when there is scarcity, when there's a large amount of stress, it's the true nature of that person actually comes about. So it's not something you can actually quantify. It's not something, there are no matrices to actually judge that. It's more or less something that's actually subjective and actually relies upon the person. So the kind of gut feel that you have, that intuition as to whether this person can actually do it or whether this person can't, actually plays an outsized role when it comes to actually investing, especially in the early stage. Of course, you still have to do hygiene points, let's say your due diligence, see whether it's viable, check the market conditions, check competition, check whether the business is large enough, etc. But the largest bet you'll actually end up making is a bet on that particular person. So that's why especially when COVID actually went away and the lockdowns went away, the first thing everyone did outside of visiting their parents and friends and everyone was to actually visit their portfolio, and more often enough for the new deals that they do, actually go sit across the table with them, have a coffee, and just have a conversation. More often than not, these conversations are not about the business, not about your plan, not about your deck. You will actually end up getting a very good read on the person, and that read on the person actually ends up informing your decision to actually invest in them or not. So I think that's the most important thing. The market, like I said, rewards good behavior in the long run. You can manage to fool a few people for a short amount of time, but all this actually comes about. So never actually look for these low-hanging fruit. Always look into the horizon for something that can actually end up creating value.
Excellent. I suspect along with that is also, as the scaling becomes important, I guess it's also the kind of leadership team the entrepreneur manages to surround herself or himself with, and I think that becomes critical as well. We have completely run out of time. I apologize to the organizers. Have taken 10 minutes more. I think I was given time till 5:12. It's 5:22 now. Are there any questions, Prateek, that from the audience that we have to address?
Anand, I have one question for RSP and VKT. Okay, they were the first education entrepreneurs that I have seen. I want to know from their vantage point, how do they see the way they built NIIT from the Barsati in Sadhajang enclave? I've been to that Barsati where RSP used to sit, to today's world of unicorn, decacorn, valuations, and all of this stuff. What is their summary of this particular evolution?
So I'll take a first shot and then Vijay will always correct me, as we know. I think to me, the key thing is that education is an extremely complex area. We have to start with that reality. We do talk a market of one or whatever, but Vijay and I were in college together, and I'm sure we attended a class and came out of that class having got different things, even though we are so similar and everything. So and also, if you go into the class with a headache, you learn much less than you do if you're fully energized. So every learning transaction for every person is different and unpredictable. And that is why, early on, we said we're not in the teaching business. We are in the learning business. We never use the word instructor. We always use the word facilitator. The learner is trying to learn and you're facilitating the process. And that has held on good. Whatever we did, we just focused. And the point has been made again and again. What does a learner really want? What is the real need? And I think we just kept responding to needs as they came, very, very with the ear to the ground. So putting yourself in the shoes of a learner is, I found, far more difficult than putting yourself in the shoes of anybody else, because you can't generalize. And therefore, even the activity that you do has to listen to each learner every day. To me, I think that's been the key thing, and we continue to work with that and struggle with that, because the moment you start doing cookie cutter things to get segmentation and so on and so forth, unless you have a mechanism that you can learn from every learner what they're experiencing as they go, and you have feedback loops and corrective action loops. So Vijay, for example, tells the story of the first guy who came, one of the first guys was a shippy in Bombay. And that guy was very irregular. And Vijay told him, I'm going to get after you till you finish what you have to learn until you've done it. And remember, I'm going to be after you, as a symbolic action. So I think that mentality perhaps has been what has kept us excited. That's what I would say. Vijay, you want to add something?
Yeah, in the context of just now's discussion, I mean, there's lots to talk about. One I want to say is that education is a business of heart in addition to that of mind. So why I'm saying so is because if you are not fully into it, and when you are entering it, you are planning your exit strategy, then chances are that you are not going to be reaching too far. That's one conclusion I came to. You have to be all fingers, all pies in everything into this. This is one experience I have. And the second is that it's a very large time constant business. So we keep talking of value and valuation, and we think that our entrepreneurs don't understand that. I'm sure they understand that. But the investors want a quick return. The question is, by the time you complete, take the case of the business that we were in, by the time you think you have realized or delivered value, A, you should have acquired the customer, B, he should have learned, C, he should have got placed, 4, he should not have got fired, and 6, he should have referred his friend to come to do your course. That is one value cycle. How long does it take to derive that? And by the time you derive that, is your investor going to wait? So I think that part is sometimes get missed out, and therefore this whole infatuation with, I would say, volume or showing one case and calling that a used case, and then after that, extrapolating that. I think that euphoria comes from there. Those are two things which I think are very strong in my mind.
Anand, your experience, Anand, in the private equity in education space. Last question. I know time is running out, but you have done education business with private equity capital and given exits and all of that. You have been through that cycle too. Yeah.
I think there are a large number of investors who understand education. I think there is an inherent problem that they all face. The cyclicity that exists in the private equity world, investment to returning the money to the LPs, and the cadence of the education sector don't match. But it's like a Garba dance, To be able to get into the Garba cycle, you have to get into that cadence to get in. Private equity and education oftentimes are not in the same cadence. That's the problem. There are people who get it, and I've had some wonderful board members who've really understood that, got it, but be constrained because they are under their own business model, which has got the 8+2 and all of that stuff. So I guess, and I think that's what I think Vijay also alluded to, saying, that's the, and we have all seen it. VCs are, I found VCs to be a lot more understanding, and VCs understand a longer cycle. With PEs, the cyclicity and the spreadsheetism is a lot more acute. And I think that's the one big difference that I have seen.
Good. Thanks.
All right. I think we've come to the end of the session, taken a lot of extra time. My apologies to the organizers.
You can blame me.
Only 8 minutes.
We got an extra session in this moderated.
I don't know who's is the next. Pramod is the next session.
Pramod is waiting patiently.
Anand, the apology is only to me because you have kept me waiting.
No, Anand, Anand, you can blame it on me. The last 3 minutes was on me. Okay. Yeah. Hi, Pramod.
Hi. Nice to see you.
Thank you, everybody. Thank you very much.
You've said everything I needed to say. So what am I doing here anyway?
I have questions for you. Don't worry. I have questions.
All right. Thank you very much.
Thanks. Always a pleasure.
Thanks. Okay, great. Great talking to you folks. Yeah.
Back to you, Neha.
Thank you all for such an